Oil shocks have always raised ominous signs for the global economy, not only because of its linkages to the economy, but also because of various episodes of US recessions which have been preceded by a sharp surge in oil prices. Let's do a three-point analysis to understand what could the current oil price surge have the implications for investors as also the central bank firefights the current slowdown. 1. What is the current situation of crude oil? Well, the murky politics of the Middle East has been the originator of all oil shocks, and the current one is no different. The attack on Saudi refineries has raised the scary prospect of an escalation in the Iran and US military skirmishes, and also the risk of large-scale disruption of oil production in the region. Interestingly, Saudi Arabia may itself want to keep oil prices elevated due to its weak fiscal situation. Now, oil prices are already up 22% from the lows, and given the subdued global growth, it raises specter for stagflation, which may culminate into a recession. Now, this leads into three possible scenarios for oil prices in the near term. Firstly, they could remain at elevated current levels. Secondly, surging past $80 per barrel and trading in the range of $80 to $90. Or thirdly, moving past $100 per barrel mark. Right now, there are higher chances of prices to get normalized. Over the years, the dependence on OPEC supply has also lowered with the new supply coming from the USA. Temporary disruptions like the Saudi Aramco can be handled, albeit with a lag. Further potential supply outage from Iran in case of a possible Iran-USA escalation may not vary significantly as a factor as the world is gradually getting used to the Iran sanctions. Now, going forward, higher range of oil price and duration would depend on how the current crisis escalates from here and how quickly Saudi Aramco rectifies the operations. 2. Can the current situation lead to a recession? Well, the current crisis may not become a leading cause of recession, as in most cases of the oil price shocks leading to a recession, the quantum of price surge has been more than 100%, for which we see a limited possibility right now. Secondly, global central banks are already positioned for a synchronous accommodative monetary policy, which should partially offset the growth headwinds arising out of the oil shock. 3. What are the implications for India then? Well, in the near term, implications for oil importing nations such as India is negative from the FII flow perspective. Further, the usual talk about fund flows from the Middle East to India picking up when oil prices remain elevated is also missing. Over the years, particularly after turmoil in the early part of 2016, share of sovereign wealth funds in FII's assets have also declined. Now, this has partly to do with the weaker outlook for the oil market, wherein the structural changes in the energy world may have dimmed the investment appetite for Middle East-based sovereign wealth funds. Only solace over the period is that share of relatively sticky fund flows from, say, pension funds have actually increased for India.